Good morning. Welcome to Market Monday for March 25th, 2024. Last week, as widely expected, the Fed held rates steady at its March meeting. As Chad's been talking about the last couple weeks, headline inflation has been stickier than originally thought, despite the various reasons discussed here, like perhaps an artificially high owner's equivalent rent reading. Even when or if inflation does come back down, even if it gets to zero, remember, inflation tracks changes, not levels. Here's a look at the aggregate inflation level since January 2020, a 24% increase in the overall price level of goods and services. We've all felt it. So even if inflation goes to zero, this level will still be 24% above where we were in January 2020. Folks, being in cash feels safe. And for now, you can at least earn a respectable rate. But that's likely going to fade away soon. And feeling safe in the short term is a very good way to destroy your purchasing power in the long term. To keep pace with inflation, to maintain purchasing power, we must invest in asset classes that are designed to do that, which naturally involves risk. Risk is a feature, a part of the game, and it's our job to work with you to identify what risks we want to take, to try and get an appropriate or prudent level of those risks, and then manage them on an ongoing basis. Okay, something else we've been talking about is the investment case for Bitcoin gaining popularity and legitimacy, even showing you how Fidelity Canada added Bitcoin to their all-in-one portfolios. And just as we predicted, BlackRock quickly followed suit, filing to be able to purchase Bitcoin in its global allocation fund. Again, not an endorsement for or against Bitcoin or any fund mentioned here, but it's happening whether we talk about it or not. But not so fast. Here's Tim Buckley, Chairman and CEO of Vanguard, yes, that Vanguard, discussing his views on Bitcoin.
Spot Bitcoin ETFs. Question came in, hey, we know you're not offering one. Have you changed your mind? What would it take for you to change your mind? We don't plan to, and we're not going to change our minds around this unless the asset class changes.
Yep.
Why? First of all, we don't believe it belongs. Like a Bitcoin ETF belongs in a long-term portfolio. Someone's saving for their retirement. It's a speculative asset.
That's exactly it.
And the funds that we offer invest in asset classes that actually have underlying cash flow. So, like we mentioned stocks, you're buying the forward earnings of a company.
That's right.
And that bond, right,
has coupon and principal payments.
Yeah, you're going to pay me back and you're paying me something for lending you the money.
Exactly.
Right, so they both can be valued. And that's, for us, we can understand why they would rise up in a portfolio and the role they will play, and we can model them. Something like Bitcoin is just too volatile, and it's not a store of value. It hasn't been. And it's very volatile. When stocks got hammered in recent crises, that Bitcoin went right with them. And so it is speculative, really tough to think about how it belongs in a long-term portfolio.
All right, no mincing words there. We don't offer it. We're not going to change our minds. It's not a store of value. It's a speculative asset with no underlying cash flows. So don't feel too bad if you don't understand Bitcoin's role in a portfolio. So where does that currently leave us in traditional public stock markets? As a reminder, these composites or averages we show you are simply what's happened in the past. It's not a claim on the future that it must play out in a certain way. Markets are open systems with no promises or guarantees, but it does provide some context and a frame of reference. Here's one looking at every year, every election year, and every 10th year, blended together here in blue, and the NASDAQ stock market here in yellow. Here's another one looking at every election year under a new president. Here's the S&P 500 stock market this year in blue. We're not pulling the alarm bell, but we are suggesting it wouldn't be outrageous to experience a pullback, perhaps even a sharp one in the months ahead. If that happens, let's keep cool heads despite nasty headlines and intelligent sounding reasons why the next crash is around the corner. After all, when the S&P 500 stock market is up 5% or more on day 50 in the year, the rest of the year is usually higher, over 12% on average. Have a great week.